What's going on, guys? This is Nazar, and today we're going to talk about a potential 2020 recession. I'm pretty sure you've heard or you read somewhere a lot of articles have been coming out since 2016 predicting a recession. Now, we've only seen growth since 2016, 17, and 18. However, this time they're providing some indications as to what could be driving the market in that direction. In this video, we're going to talk about these indications. We're also going to talk about ways to protect ourselves just in case a recession does take place. What are these indications that are causing everybody to talk about a recession? Well, one is the trade war with China. The US government has placed higher taxes on imports from China. And what that does really, in my opinion, it just makes things more expensive. And when things are more expensive, people are less likely to buy stuff. And when people don't buy stuff, it negatively hurts the economy. Now that's one. Another one is the infamous inverted yield curve. The US Treasury is basically yielding higher rates within a short period of time versus the normal curve where yield higher rates at a long period of time. And to give you an example, let's just say you open a CD. A bank is more likely to give you higher rates if you let them hold on to your money for a long period of time. A 6-month CD versus a 5-year CD, obviously you're going to get a higher rate on the 5-year CD. With the inverted yield curve, economically, it doesn't make sense. If you look at a graph of the curve, it shows that the rates are actually slightly higher for 2 years versus 10 years, which means that, like I said, investors are speculating, they don't know what's going to happen, and therefore they hold on to their money in cash, and so when investors don't invest in the market, obviously it hurts the market. Another factor is the fluctuating interest rates. And so in 2018, we've seen rates as high as 5%, 4.5% on average. Now in 2019, we're seeing as low as 3.5%, which is amazing, by the way, because you can always lock in at a fixed interest rate for the next 30 years. But my point is, with fluctuation in interest rates and with the rise in interest rates, money becomes more expensive to borrow. And when that happens, when it costs more to borrow money, people are less likely to go out and get loans and buy homes. And when people don't do that, you have a lot of supply on the market, not enough demand, and therefore it hurts the economy. Another factor is the tremendous growth that we've had over the past decade. So you obviously want to grow and you want your house value to go up. But 15% is flat out unsustainable, right? And so we have to come to a plateau, at least for a little bit, to accommodate the housing market. So now that we've kind of discussed what indications are showing, let me tell you something. Nobody, and I mean nobody, really knows what's going to happen, and all these are predictions, right? Instead of spending time and energy focusing on things we can't control, let's focus on things that we can actually control. Let's mitigate risk. The way we can prepare, number one, is buying in a good location. Like real estate is location, 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 right? So you want to buy in an area that has good proximity to schools, to employment, a good area that's in demand, right? So location is number one. Another thing is buying below market. And I put heavy emphasis on this. If you buy below market, you're not going to get affected. Even if the market does adjust by 10, 15, 20%, the worst case is probably you'll break even or you'll make less money. But you're not going to be under the water if you buy below market. Another way to save yourself is buying with a 30-year fixed interest rate loan, right? You don't want a variable loan that will change depending on how the market behaves. You don't want a balloon payment loan that you have to pay that big payment in 2 to 3 years. You want it to be fixed, so you know exactly how much you're paying every month. Also, you want to buy within your means. A lot of people max out and buy something all the way up here when they can afford something down here. Another way to prepare is to buy and hold. So you buy something and you hold on to it. You don't sell, you don't panic. Like this is what happened in 08. A lot of people panicked and sold, and that's where they lost. Had they just kept and held on to their real estate assets, they would have tripled. You gotta play the long game. Unless you're an investor, that's a whole different thing. If you're an investor, then timing the market is crucial. You wanna buy at the right time. But if you're not an investor, if you're buying something to live in, then it really doesn't matter when you buy it, as long as you hold on to it. And also, if you are an investor and you buy something to rent it, then you don't really care about the value, you care about cash flow. Your rent is covering your expenses and your mortgage, and then you don't really care what the market does, if it goes up and down, because real estate cycles. You're going to have your highs and lows, and nobody can time it. It's not as easy as, oh, every decade the market will go down So I'll buy, and then so I'll buy low and sell high. It's not that easy. Everybody would have done it if that was the case. All right, so just to recap on what you can do to prepare, just in case a recession does take place, you want to buy in a good location, right? You also want to buy under market value. You want to buy with a fixed interest rate loan. Save a little bit of money, like 3 to 6 months of savings. Buy under your means. And just to give you my opinion, I honestly don't think we're going to have a crash like what we saw in 2008. I think our market is a lot healthier, and people now are more aware. You know, recessions happen when you least expect them. Now that everybody is kind of pumping their brakes and investors are holding on to their money and people are not buying as much, or they're not being foolish with their purchases, they're not bidding houses, and they're buying within their means. And so all these are indications that we're not going to have a recession. However, I do feel like the market is going to slow down a little bit, which is good for investors. And think about this. If you're buying rentals that cash flow and people are on the other side panicking and selling, right, then they're going to need a place to live, right? And so now you have more tenants. There's a lot more demand, and yeah, I think you get the idea there. Alright guys, so I hope this helps kind of clarify some things. And remember, riches are made in recessions. So even if a recession does take place, then be prepared to buy and buy aggressively. If you have any questions, feel free to reach out to me. Also, if you like this video, like, subscribe, comment, whatever it is. Until next time, I'll see you.